Imagine running a business, having a rough year, and the IRS telling you, sorry, you can't deduct all those losses. Yep, that's a real thing. And it's called the excess business loss limitation. The One Big Beautiful Bill didn't kill it, but it did rewrite the rules you need to know. The One Big Beautiful Bill keeps the excess business loss rule in place, but updates how the limits are calculated. Starting in 2025, you'll be limited in how much business loss you can deduct against non-business income, like wages, interest, or investments. But the threshold has been raised slightly, and carry-forward rules remain in place. It's not great news, but it's more predictable. Let's define it. This rule limits the amount of net business loss a non-corporate taxpayer can use to offset other income. It applies to sole proprietors, LLCs, S-corps, and partnerships. Anyone not filing as a C corporation. For 2025, the limit is $610,000 for joint filers and $305,000 for single filers. Any losses above that? They don't disappear. They get converted into a net operating loss and carried forward to future years. The excess business loss limitation was introduced in the 2017 Tax Cuts and Jobs Act as a temporary cap on how much loss you could use each year. It was extended by pandemic legislation, then briefly paused, and now the One Big Beautiful Bill makes it a permanent fixture in the tax code, with inflation-adjusted thresholds and clearer treatment of carryovers. So if you're planning to deduct big business losses, you'll need to know your limits every year. This rule affects business owners with large operating losses, real estate investors with significant depreciation, farmers or cyclical businesses with down years, anyone offsetting business losses against W-2 income or capital gains, and high-income filers with passive losses from multiple activities. In short, if you're expecting a paper loss of more than $300,000 this year, this rule is likely hitting your return. Let's say you're a married couple filing jointly. Your business reports a $1 million loss, maybe due to expansion, equipment purchases, or a tough year in real estate. You also have $300,000 in W-2 wages and $100,000 in dividends. Can you use the full business loss to wipe out your tax bill? Not anymore. You'll be allowed to deduct up to $610,000 of the losses in 2025, but the remaining $390,000 gets carried forward as a net operating loss. That means you still pay tax this year, even though technically you lost money overall. Pro tip: don't let this rule catch you by surprise. Here's what to do. Work with your CPA to project your income and loss mix. Use entities and elections to manage which income gets matched with which losses. Plan ahead for big losses. Don't assume you'll deduct everything at once. Consider strategies like accelerating income or spreading out deductions. And track your net operating loss carry-forwards carefully. They can offset future profits. Excess losses don't vanish, but timing is everything. Plan around this rule, and you can still win in the long run. Glad you could join us. If you are ready for a smarter approach to taxes, check out TaxSmithing, our personalized tax strategy process. Reach out to us anytime.